Hello, everyone. This is Sharif Khalid. I am Business Development Executive at Diamond Professional Consultant. We are an Oracle Golden Partner. We help the organization in the digital transformation as we are specialized in enterprise performance management, business intelligence, and artificial intelligence. In today's webinar, we are going to talk about scenario planning with Oracle EPM Cloud. Our speaker today will be Mr. Hatem Al-Adi. Mr. Hatem Al-Adi is a performance management director at Diamond Professional Consultant. He holds over 20 years experience in technology and management consulting with a specialization in enterprise performance management and business analytics. Mr. Hatem has carried out some of the most enterprise projects in the Middle East for various sectors that include governments, oil and gas, banking, and many other industries. So let's welcome together Mr. Hatem Al-Adi.
Thank you, Sharif. Thank you for your attendance, guys. This is our second webinar here. It's about scenario planning, and we will include some videos of Oracle EPM Cloud to explain how we can do the scenario planning with Oracle. Also, we have case study of Best Buy. It is from Harvard Business Reviews. So we can combine here the circumstances that can require the scenario planning. Now, let me start with the scenario planning here. Okay, scenario planning is a process that simulates imaginative, creative thinking to better prepare an organization for the future. Since we are talking about scenario planning, then we are talking about the future. And it's not easy to get into the future. You need to be prepared. You need to have clean data of your historical information. You need to have the right tools. I think Excel can be a good tool for small organizations, but once you have the complexity of the future understanding and the drivers, then you need to have kind of automated software to show you future. The scenarios usually can be used in long term and medium term and in short term. And I would say that you can have your strategic plan, it's a scenario. You can have your budget for 1 year, it's a scenario. You can have a forecast of 6 months, that's a scenario. Okay, and the most important, where we do need the scenario planning is when we have a crisis. And the crisis management here, we need to create a specific scenario for this crisis. And here, actually, I must say that once we have a crisis, it is now forecasting in uncertainty. And it's easy to differentiate between the certain and uncertainty. Okay. Yes, there is a say that says, if you are talking about the future, so everything is uncertain. I agree with you. However, when you speak about 1 year budgeting and you are basing this on your historical information, that means you have stable trends and you have stable actuals, and you can predict to somehow your information. But when it comes to crises like COVID-19, I think we are all in uncertain timings because we cannot rely on any actual information. Everything has been changed. Everything has been altered. The dynamics, the customer behaviors, even our cultural habits has been changed, and that's real uncertain time. And now this is the best time to use scenario planning here. So if you want to say that the future has degrees and different degrees of uncertainty, then I would be agree with you that this is has to be managed in a different way. And in uncertainty, what do we need to have? Usually, you need to maintain adequate liquidity to sustain operation each month. And that becomes a critical imperative for organizations of all sizes. That's the major key here. If we're talking about uh, how you can manage a crisis from the perspective of uh, uh, the uh, the sustainability to go the other side, and then I would say you first must stick to your long term. Okay, if you have a long term plan and objectives, then you need to stick to these objectives. Okay, and also you need to be flexible, agile, and of course you need to have a look all the time and every week, and if I would say not less than a week on your liquidity and operation, because the major disturbance on the operation side, okay, when you say, uh, let me say, what do I mean by operation? I mean here customer and a supplier and your supply chain. So these are things that you need to look at it all the time, because customers mean receivable, and supply means by payable, and inventory means by supply chain. So that's the liquidity that I do have. It's the actually the working capital I used to use to run my operation, and I have to make sure that these information are available to me, and I have to do scenarios, and I have to look at them uh, um, every week, as I said, and maybe less than this. So that's the bottom line here. When we have a crisis, then we need to have a closer look all the time on liquidity and operation as well. Now, what do we need to have a scenario planning? Well, scenario planning, it has a component, okay, many components here. And before we go to Excel or a software to do scenario planning, we must understand what are these components. And that can be done by a business analyst or a CFO who understands the management of the company. He knows, and actually, I'm very fond of the CFOs who understand really the business, and who can cooperate with the operation people to discuss with them. Because before I dig into the scenario planning components here, I'm just giving an example here. If a CFO does not understand how the operation works, he would only plan the budget from number perspectives. Okay, and that's one of the major scenarios that we depend on in the crisis and scenarios, because we have to plan from there. So if he did build these numbers from the perspective of him side, not from the operation side, then we are in separate islands. We are in disconnected mood from the operation. And that's why here, the main best practice in the planning and budgeting is to have integrated planning and budgeting processes. And I wouldn't expect that we don't have contact with the team who runs the operation to send us the projects in case we are construction or telecom, or the how we do the manufacturing in case we are a manufacturing company. We have to connect the financial with the operation 100%. So we have integrated components. Otherwise, we are not on the right track from my perspective. Now, the scenario planning components, how we can create a scenario. First, the key focal issue. Key focal issue for me means that we have something that we need to take about a decision. Now, we have, let me say, a question of, do we need to open that plant in Egypt or India? Do we need to invest in this project in such crisis? How much my sales is going down? So with the key focal issue here, it's economic change, and always the scenario starts with economic change, or a question that we need to ask about here. Now, The driving forces. The driving forces is the things that, and here I'm going from the left to the right. So the driving forces here are the things that impacts the scenario. And here, these things uh, uh, can be external or can be internal. So in case, for example, in the retail industry, we have maybe internal drivers or driving forces like the number of units sold or the price of the units. So these are basics drivers for the retail industry. Also, we can have external drivers like the government. In case of COVID here, one of the external drivers here is the number of patients you can drive the expectation of how this pandemic is going to go up or down with the drivers that comes from the external sides. Even for the sales itself, for some of the retail people, the weather itself can be external driver. Like if I expect that if the weather is not good or we have a major or a bad weather here, that my sales are going to be down. So the driving forces here are all the drivers that going to impact that decision. And that's a good point here to say that usually, guys, the scenario is usually it's not being done by one person. We need to have a team, people from in case we are, for example, in the crisis of the COVID, then we need to have people from the operation, from the finance team, and from the top management, and maybe from the supply chain. Okay, so these things are going to be kind of workshops to be done to see these drivers and determine them. Now, the critical uncertainties. Uncertainties are the things that is really critical and is impacting the decision itself, a major impact. You can say that it's kind of categorization, and you are prioritizing the uncertainties from top to down. The scenario framework is how you're going to put the scenarios. Now, I would assume that here we have one of the uncertainties is closing the stores for the retail industry. Okay, and if you have, if you are saying closing the stores is one of the critical uncertainties, then what is the scenario framework? I would say the opposite. Open the store and closing the store are now the scenario framework here. So you need to build here two scenarios. Okay, one for opening the stores and one for closing the stores, or at least you're gonna build one scenario, which is one what if scenario for what if open the stores and what if close the stores. So this is how we can extract kind of scenarios. For every driving forces, you need to get the critical uncertainties for this driver and prioritize them, and then you start the opposite and the main thing like close the stores or open the stores. Once the scenario is here clear to us, it's good for us to have a kind of narrative. Okay, narrative here, it's just writing because we are going to update this scenario while we are in the crisis or while we are evaluating this again. Also here, the early leading signals, we must keep an eye on the early leading signals. For example, in COVID-19, the government speech is early leading signals for us, because maybe they say going to lockdown, so I can prepare my scenario, I can prepare what if. Okay, and of course this will be attached with analysis of the implication and options and what should I do in such cases. So first of all, before we go to any numbers, we must analyze the scenario that we have. We must get the drivers, we must get the uncertainties of these drivers and its impact, and the scenario framework as well. What are the thing and its opposite to see to go ahead. Okay, here, well, in scenario planning, uh, that as a tool or as a concept is it gives the finance the agility to visualize the multiple what if. What we said just right now, okay, you are understanding what if closing the store, what if opening the store. Okay, so it gives you the visual agility, and here, if you can visualize these scenarios in Excel, however, how much you are agile, how much you can respond quickly, how much information do you have? And that's why we do always recommend that such concepts, it requires software to be to maintain it and to be working on it. Now, let me start with this video. Okay.
Welcome to this step-by-step tutorial on how to create scenarios with strategic modeling. With strategic modeling, you can model different business outcomes that are calculated based on different sets of forecast assumptions. You do this by creating scenarios. When you define your scenarios, you specify the accounts to include: the entire chart of accounts, a subset of accounts, or a single account. The base scenario contains every account. You add an account to a scenario because you want the values to come from your new scenario rather than from the base scenario or other standalone scenario. You can
Well, let me start by here and to explain here what does it mean to have these scenario. Definitely, every scenario is a business model for us. Okay, and here I want to differentiate how we can create scenarios. We have two approaches of creating scenarios. One is you create scenario uh, based on actual information. And the second thing is you create scenario based on future scenario. Uh, when we say actual and budget, these are two scenarios, right? The actual is a scenario, and from this scenario, you did build a budget scenario. And that budget scenario actually, it is based on that actual scenario. So all the time you need to have a scenario based on scenario. And that's why here we are saying that we have base scenario that has all the accounts, that has all the information. And after that, we're going to create a scenario on top of this to start our what if analysis. The second thing, you can create a scenario on top of a budget scenario. Okay. For example, I would say I need to create a COVID-19 scenario on top of my budget scenario to understand what's the impact. And the new scenario, you can actually select only, which is the COVID-19 scenario. You can select only the few accounts, like only two accounts in this scenario, the units sold and the price of units. So everything will be inherited from the base scenario. Information, historical information, accounts, all accounts. So this is how you create scenarios. All the time you create scenario on top of another scenario. And here, the base scenario, which is with the strategic model, it includes all the accounts, all your chart accounts. And the new scenario here, we're going to work on these only two accounts. That's an example here. Let's continue and see what's next.
create additional scenarios to conduct what-if analysis. Let's say you have one forecast in a high growth scenario with optimistic assumptions and another forecast in a low growth scenario with a more pessimistic set of assumptions. You can create these on-the-fly scenarios within each model to quickly evaluate data based on your assumptions. You can then combine scenarios from different models to create a blended consolidation scenario, which is called a business case. You can evaluate how key metrics are affected for the high and low growth scenarios, and then compare your results. Let's take a look at a report and evaluate the data within different scenarios. In this report, we can review data for the base scenario. After we change the scenario to upside case, we can see how our assumptions in upside case impact key metrics such as shareholder value. When you create a new scenario, you create it from an existing scenario. The properties and account selections are based on the currently active scenario, which in this case is upside case. You can enter scenario-specific values for the selected accounts.
All right, let me stop right here. Now, we do have, with the strategic modeling in EPM Cloud, a template. Let me call it the base. And the base here will have all your chart of accounts. I mean, the structure of your chart accounts, the ways that we agreed together, how we're going to forecast this chart of account. For example, I would say that the product sales is the multiplication of between the units and the price. So we agreed on this. So the base is, it means my chart of accounts and my forecasting methods. The second scenario will be the actual. And the actual here, actually it is based on the base, right? Because we said every scenario should be based on a base. Now the actual based on the base, and it contains my actual information. Usually 2 years could be fine to forecast the 3 or 4 years. So that's the actual. And here also we have the upside case. And the upside here, it's a scenario actually. And here we want to see what if I did increase the unit volume, product sales, discount, what's the impact on COGS and salary expenses, because everything is connected together. Now, you need to, the final destination is to get balance sheet, income statement, and cash flow on the future. So everything has to be connected here. And from in the income statement, I'm just changing the unit sold, that would lead me to the gross margin has been changed at the end. Okay, so that's the upside here, and it's only these accounts that is highlighted in red, and all the remaining accounts in this scenario, it is inherited from the other scenario, which is the actual or whatever it is based on. That's very important concept here in creating scenarios. Okay. Now let me move ahead again.
Strategic modeling includes 2 default scenarios. The base scenario includes all accounts and contains the original inputs of each account. It does not inherit any values from any other scenario. The actual scenario contains actual data. Let's create a scenario. Give the scenario a name and description. Determine if the new scenario will be an inheriting or standalone scenario. In this case, we'll create an inheriting scenario, which will inherit values and forecast methods from upside case. All scenarios inherit the input values from the accounts in the base scenario or other standalone scenario, unless you specify an input value in that scenario. Let's add some accounts to our scenario. Values for the accounts we did not select will be inherited from a...
And that's what I'm saying here. Now, the high growth scenario, it did inherit from the base scenario all the structure, okay, all the chart of account, all the forecasting methods, and also it did inherit from the upside, okay, the information itself, I mean the historical information. And only we are going to play with the unit volume and product price to do what if on the high growth scenario. So we are here, this scenario based on 2 scenarios.
Standalone scenario, such as base. If you no longer need a scenario, you can delete it. When you delete a scenario, all the data for that scenario is also deleted. We can see here that we have multiple scenarios within the same model. To change a scenario's characteristics, edit it by selecting its edit icon. In the point of view bar, select a scenario to review data for that scenario. After calculating the high growth scenario, we see updated account data for that scenario. Accounts from upside case are also displayed since we selected upside case as the scenario from which high growth inherits. Since high growth was created based on the base scenario, the unit volume, product price, and product sales data is the same as the data in the base scenario. So, to start, unit volume for 2020 for both base and high growth is a little over 19 million, and product sales for 2020 for both scenarios is a little over 861 million. Since high growth inherits logic and data from upside case, the logic and data for those inherited accounts is also in our high growth scenario. For example, cost of goods sold is calculated as a percentage of sales. For both the upside case and the high growth scenarios, the 2020 value is over 66%. We can change the data.
Let me revisit this again. Here actually these are the drivers that we have here. Now we have 2015 and 2016. These are historical information, and we did inherit this information from the upside. Remember, we are in high growth scenario, okay? And we did inherit the information and historical information, and also the forecasted information from the upside, okay? Where we did inherit the all the accounts, which is the unit volume, the product price, the product sales. We did inherit this from the base scenario, okay? Here, you can see the highlighted yellow, which is forecast as growth here, unit volume. These called forecasting methods because everything here is forecast. Now we're going to forecast the unit volumes. We're going to forecast the product price. We're going to forecast the discount and returns. Everything is forecasted. It's a complete image based on math and based on our understanding. So the different forecasting methods here can be used, and actually they are already implemented in the base scenario. So as you can see here, we have growth rate of 4% on the unit volumes, and we have $45 that's forecast in dollars for the product price, and this multiplication will comprise the 861 of the product sales. This is how we are understanding how we can forecast. Changing the values of the forecast for the growth rate or the product price will change the product sales and also the COGS. If you can see it here, it is 66% of the revenue, and which will give us like 667 million of COGS. So whenever you change anything, you have everything has been changed. Okay, that's the concept of scenario planning. And here we are focusing only on the drivers and accounts that that is related to the income statement.
Is over 66%. We can change the data for unit volume or product price within the high growth scenario to calculate product sales for high growth because we added those specific accounts when we created that scenario. Before we enter data for the high growth scenario, let's take a look at the income statement based on the price from the base scenario and the logic from the upside case scenario. This is our cost of goods sold. Now we'll enter values in the high growth scenario. After saving and calculating, we can return to the income statement and see the impact on cost of goods sold. You can make it easier to find commonly used scenarios by changing the scenario order. This also changes the order in the point of view bar. I will move high growth so it is listed close to the top. Base and actual cannot be reordered and are always the first and second scenarios in the list. Here you can see the updated scenario order. In this tutorial, you saw how to create scenarios with strategic modeling. To learn more, visit cloud.oracle.com.
All right, that was a kind of a brief of how we can create scenarios and how we can change the drivers to get different views. You can create whatever scenarios, multiple scenarios in different cases. For example, in COVID, worst and best cases, if you have a intention to add a capital, you can create a scenario that says, okay, I'm going to add this much of capital, then what's the impact on the whole organization? Okay, Best Buy, that's a case here, a case study here. Best Buy, it's a retail company. It's founded in 1966 by Richard, and it's actually a sound of music and stereo equipment retailer. And in 1992, they did a very well growth, and accordingly, they changed the concept of how to strategize and win clients. And Richard said, in our world, the way you win the game is not the price of the TV, which is about the same for all retailers, but the experience you give customers once they are all in our stores. And he did change many processes to not compete on prices, but to compete on quality, on how to serve the customer and how to be obsessed of the customers. In 2014, Best Buy succeeded and opened more than 600 stores in 48 states, and they did expand to Canada, and after that to China, Europe, Puerto Rico, and Mexico as well. And that was a big expansion for them. And in 2012, the Jolie CEO has stepped to be a CEO and announced a new strategy to continue what Richard had did start. And he's focusing on the customers again, leaders and employees, vendors, investors, and community. And actually, he started to focus on how to serve again the customers in a better way. Well, in 2019, Best Buy hired Corey Berry as a CEO. And at that time, their revenue was nearly $44 billion. And Corey Berry, actually one of the very, very talented CEOs who did manage the crisis in a very impressive way. In 2020, Corey Berry, they did hear about the COVID-19 and how this is going to impact. And in early 2020, they saw different ways and how to respond to this crisis. They have to put the guidelines because there are many ways to respond to this. And actually, in that respect, they agreed as a top management to go with 3 guidelines. First, to make the safety of employees and customer of Best Ways the highest priority. And second, to avoid layoff as long as possible, even if stores were forced to close. And that was a major decision because the expenses of the salaries is one of the major expenses. And the third is to make decision based on long-term value creation. And they agreed, the CEO, Corey Berry, with her team, that any other decision is going to be, has to be fall into one of these guidelines. Otherwise, it has to be removed. Well, still uncertain times. It's still they cannot even judge whether this decision is going to be falling right or not. And that's why they have to study, analyze all the time. Corey Berry actually, she did agreed on a weekly review with the finance to understand every decision and its impact on the financial situations. And she also engaged the operational top management because she will focus on the balance sheet and operation. And this is emphasize the word that you need to focus on the receivable, payable, and as well your supply chain in terms of inventory. And these were the problems they were facing, the safety concerns, because we are in COVID-19 and everything is not clear, and how to do the safety, sanitize, or get whatever tools they need. Also meeting the customer where they want, because in retail, if the stores is going to be closed, how they going to ship to the clients their needs? And at that time, they agreed that they must emphasize the e-commerce website. They were not ready that much. However, they started to move very quickly. And also the expectation was a problem because they were not ready. However, they understand that the customer is expecting high quality of their responses. So if they are not going to go for the stores to get the purchases, then they expect a communication in a nice way, in organized way that tell them how to pick the goods and products. So that was another problem, and the technology itself. What technology is going to be used to move from this crisis? And here, well, they got 9 scenarios. Okay, they did analyze a lot, and they tried to see what are the triggers that impacts all the areas: the digital, the supply chain, service centers, because it's going to be closed, home service is going to be stopped, home sales going to be stopped, and then they got the possible scenarios here, like open for shopping, which means the shops is going to open. That's before March, okay, where everything is not clear. We are in uncertain timings, and here also they can close the stores 100%. A lot of scenarios. They got 9 scenarios, and they don't. They are moving around the scenarios, evaluating the cash and evaluating the decision. At that uncertain time, you need scenario planning, definitely. And here, I would say smart companies are shifting their focus from the income statement to the balance sheet, okay? And you need to understand what is your cash flow, and every decision impacts your cash flow. Now, let me see here, how can Oracle EPM Cloud can help you in forecasting the balance sheet and cash flow? And this is the most important time that we need it.
Welcome to this step-by-step tutorial on how to plan for balance sheet and cash flow accounts. Financials provides an application framework that uses driver-based, trend-based, and direct input accounts that fully integrate with your income statement, balance sheet, and cash flow statements. This tutorial focuses on planning balance sheet and cash flows and how they are closely linked to the income statement plans. For some balance sheet accounts, such as accounts receivable and inventory, you can use drivers to calculate the account's value. For other accounts, such as cash and bank, you can plan using trends. For accounts which are not driver or trend-based, you can directly enter values.
Well, let me stop by here to say, well, the planning itself has to be kind of integrated planning process. For example, you need to do the planning of your capitals, okay? And you need to do the planning of your projects. And also you need to do the planning of your workforce, okay? And all of that is going to submit its information in the balance sheet, cash flow, income statement. So whatever you are planning for 1 year or 2 years or 5, or even during the crisis, if these information are not integrated together, then we are working in separate islands in disconnected area. And that's one of the major points here, to have integrated operational planning and budgeting. Also, during a crisis here, we said that balance sheet and cash flow is real important and worth to be understood. So how are you going to forecast your balance sheet? And the receivable, we said, it's DSO. You can use the DSO to be forecasted. The inventory can be in your KPI or measure, which is the days, days of the inventory. Also, the cash itself can be used in trend, and you can put the direct input of your short-term investments. So these are the major things that you need to focus on as possible during the crisis.
And for some driver and trend-based accounts, navigate between sections using the links on the top of the page. You can plan for current assets, such as accounts receivable and inventory, and fixed assets such as depreciation. And you can plan for liabilities, such as accounts payable, short-term loans, or equity, such as retained earnings. Retained earnings is derived automatically. Let's note the following values: over $432,000 for accrued expenses, and over $67 million for accounts receivable. We'll be making adjustments to the drivers for these accounts to see their impact on these balances. We are going to plan for our accounts receivable, which is derived from the days sales outstanding driver. For your driver-based accounts, you can enter your assumptions here and make adjustments here. So let's say you want to take the current month's actual for days sales outstanding, or DSO, and for the accrued expense as a percentage of operating expenses. However, you want to include a 3-day increase for DSO and an additional 2% increase for accrued expense. The calculated total from your assumptions, based on the current month's actual value, plus the 2% increase in accrued expenses as a percent of operating expenses, can be seen here.
Well, this is one of the major ways of how you can forecast your balance sheet. As you can see here, we have here the entity, which means you can forecast and do your scenario on department level, on country level, on whatever hierarchy you have. You can have here multiple scenarios as well: forecast, best case, worst case. You can have also different versions inside that scenario, so you can help you here. Also, these are again assumptions. You can put assumption for the DSO. It says here current month actual. Assumed we are in forecasting 2016, and we are in September. Okay, 2015. If I'm now saying current month actual, then I'm copying from September 2015 to the year I'm due forecasting, which is 2016. Okay, so that's when I say current month actual. There are different, again, forecast methods like average of last year. It's not in the balance sheet, of course. Okay. Also, after that, you can put the adjustments here. Once you finish your information, this will impact the balance sheet automatically.
Let's take a look at the calculated values based on the driver information you entered. After you enter your assumptions, you can review the pre-configured balance sheet, which includes calculated values based on those assumptions. Accounts receivable is derived from the days sales outstanding. DSO is the number of days it takes to receive the funds from our customers for purchased goods and services. Accounts receivable increased from over $67 million to just over $78 million. Accrued expense also increased. You can also enter additional adjustments on this page. For those accounts that are not driver-based, you can plan for those accounts based on trends. Let's say you expect to better manage your cash, so you plan to decrease the surplus cash in the plan by 5%. Similar to driver-based accounts, you can adjust the trend up or down by a percentage or make an adjustment to the calculated value. Here we can see calculated totals for balance sheet accounts based on the trend information you entered. You can make additional adjustments on this page. You can create reliable future plans by basing them on trends. Your plan data automatically flows into the pre-configured balance sheet. The latest year-to-date values are automatically updated without having to modify the form.
Well, this is one of the forms that you can use to sense the impact. It's actually the balance sheet. You can use it in different ways. Now we are in 2015, and we are doing what if. That's for 2016. So if you can see here, you will find 2015, and that's the actual of 2015. And this is the plan, which is the budget of 2015. And this is the actual versus plan here. Another way of peer-to-peer analysis, we are sitting here that 2015 forecast and 2016 forecast and comparing the forecast itself. So now we are comparing different years with different scenarios. And what we have changed before on the DSO, it is impacting our forecast on 2016. So if you can see here, the receivable has been increased, and which means you need to have a look on the cash, because that may be a signal of something wrong here to increase your DSO.
Find the prior year and current year's data on this page, as well as the forecast and actual data. Next, let's go to the Direct Entry tab. For accounts which you cannot plan based on drivers or prior year, current year, or trend-based values, you can manually enter or edit data. For example, our Corporate Initiatives Department provides an estimate for short-term investments. You can manually enter the data here. If we take a look at the balance sheet, we see the short-term investment value automatically updated. The value is increased by the $450,000 that we just planned. Here you see that the full balance sheet plan is derived from your inputs, and it includes information from the income statement as well as other sources. Now we can take a look at our cash flow. Here you can see the cash flow for your organization. Cash flow is calculated indirectly from changes to non-cash accounts on the balance sheet and income statement. Cash flow reporting derives the cash flow based on changes to balance sheet accounts, such as accounts receivable, inventory, accounts payable, depreciation, and other investments. You can make adjustments to your derived cash flow. On the Direct Entry tab, you can enter information for accounts which will not be derived. For example, you can enter a value for dividends paid. In this tutorial, you saw how to plan for
Well, we have seen here 3 ways of forecasting the balance sheet. Number 1, the driver-based, where we have KPIs or measures with percentages of for example, the percentage of accrued expenses, percent of total expenses, or my OPEX expenses, the DSO, the number of days. So there is a measures. Also, there is a trend which goes to the accounts like cash. For example, you can say it's like previous month or previous year this month, and also you can put the direct entry together by your hand. Now, back again to the our case study based by the March came and the pandemic gets worse, and actually we had to start taking the decision. They understood that there are different scenarios and they are prepared with these scenarios. Now, it's clear that everything is going to be locked down, and the operating model is only the curbside pickup, which means that people are going to pick up their goods out of the stores, and the stores is going to be closed. So that's a huge impact on a 44 billion organization, which would require a lot of changes. They took a lot of decisions. They started to transform the people to work from home, and they started to give thousands of employees a holiday, not paid. However, the CEO tried the best to give them 3 months and to make exceptional assistance to people who are not able to leave. There was no layoff. Actually, they did stick to the guidelines. They did agree on it before. More than decision has been taken. They draw down $1 billion as short investment to keep the networking, the operating expenses working. Now, what is happening here? They did navigate the crisis with minimizing the cash and monitoring the cash itself. However, now they started to reopen again 200 stores on May 2020. However, still the cash is king, and we don't understand how much cash is coming. Still, it is uncertain. Yes, we did saving the employee salaries. We did saving a lot of things. We did draw down a $1 billion. However, we are keeping a look at the cash to move ahead from this crisis and to find the economic consequences, as we said, of any decision needs to project the cash flow effects of that decision. Now, I would say that the cash assumptions is for any decision has to be clear. So the initial investment of anything, they had to invest in technology, in software, in different supply chain processes, and in every capital investment, they were analyzing and changing the drivers, like the initial investment, what are the variable and fixed expenses, what is the growth rate of sales or the return on investment of this project, and what is the tax rate, how it's going to be handled. And of course, such free cash flow method was very important to be studied. If you can see here, the cash revenue and the cash variable expenses and the fixed, and then the depreciation, and it gives you earning before interest and taxes. And at that time, you can also, after that, get the net operating after tax, and again subtract the depreciation, because it is not it's not cash. Actually, it's not cash subtraction, because we need to get the free cash. That's one of the ways that people are working. That one of the way that people are working to evaluate their free cash. So they did subtract again the depreciation and the change in net working capital to get the free cash here. And about direct and indirect, there is no rule of thumb here which one is the best. However, usually the indirect cash flow being used in reporting, in external reporting. However, I do personally prefer the direct cash flow when it comes to management of the crisis, because I need to see where is the problems directly and what are the free cash flow in such a way. They did reopen the stores in June 2020, okay, and they bring back all the people they got from vacation on November. They started to bring them back in November 2020, because they know what is happening. They understand. They are taking decisions that impacts billions of dollars, and they are focusing on the cash, and the focusing on the impact itself of every. Excuse me. They are focusing on the impact of liquidity for each decision. However, now the probability of that decision was not accurate, and we need a way to have this as accurate decision.
In this tutorial, we'll show you how to run simulations to help improve forecast accuracy in strategic modeling. Strategic modeling simulations use the Monte Carlo method to automatically generate hundreds of what-if scenarios for your model. Each what-if scenario is considered one trial of the simulation. Before running simulations, you must first identify the uncertain inputs in your model. These are called assumptions, and you describe the uncertainty for each one by selecting a probability distribution from a gallery. You then identify the key outputs of interest in your model. These are called forecasts. During each trial of the simulation, random numbers are generated for each of the assumptions according to the range you defined. The model is recalculated, and the output values are retrieved and added to the forecast charts. This process repeats until either the maximum number of trials is reached or until you stop the simulation. In general, the more trials you run in a simulation, the greater the accuracy of the statistics and percentiles information shown in the forecasts. The final forecast chart reflects the combined uncertainty of the assumption cells in the forecast cell. In strategic modeling, two types of simulations are supported. Monte Carlo sampling generates natural what-if type scenarios where each assumption is sampled randomly. Latin hypercube sampling generates more accurate statistics and percentiles by sampling each assumption more evenly across its range. My model includes accounts used to track several revenue drivers and key expenses impacting the bottom line. I am tasked to examine the profitability of the company's expansion plans to add several more high-end retail stores. My goal is to forecast overall sales for the company in the coming year and the likelihood of achieving certain targets. For uncertain input accounts, my what-if analysis is done by entering different values based on my best guesses. After recalculating data, the updated sales value becomes the new base case for my what-if analysis. Running simulations allows you to visualize scenarios in your model using a range of results, a certainty range, for each uncertain input. To run simulations, you must have modeler permissions. To start, determine key input cells and define them as assumptions. The forecast as a growth rate cell for unit volume contains an uncertain value that drives the value of total sales revenue, an account I want to evaluate. Next, select the distribution type that best represents your knowledge about the uncertain input. The type of distribution you select depends on the conditions surrounding the input. To select the correct probability distribution, evaluate the input in question and list the conditions surrounding this input. Review the descriptions of the probability distributions. As you review the descriptions, look for a distribution that features the conditions you have listed for your input. The probability distribution descriptions for strategic modeling simulation section and the Working with Planning modules documentation describes available distribution types in detail. For unit volume, I'm selecting triangular distribution. Decision makers can use the triangular distribution to describe uncertain inputs when the minimum and maximum are known, but most values will occur around the likeliest point. I'll set the minimum, likeliest, and maximum parameter values based on historical data. This creates a positively skewed distribution. I'll define another assumption, service revenues. This time, I'll select normal distribution. Decision makers can use the normal distribution to describe uncertain inputs such as the inflation rate or periodic returns on assets. The parameters include mean and standard deviation. You specify a fixed value for these assumption parameters. For the maintenance revenue assumption, I'll select uniform distribution because I know the worst and best cases based on past experience. Now, I'll define a forecast cell. Forecast cell.
Well, this is the Monte Carlo analysis, and here the question is how I can get the minimum and maximum to get the certainty. It's about we are here providing drivers to get certainty and differentiate from uncertainty. I would say the first benchmark performance, you don't have it. If you don't use to work with Monte Carlo, if you don't use to work with forecast, then the first drivers and first numbers will be hypothetically based on your understanding. And day after day, you will have the right numbers, the right understanding, okay, and comparing different performance benchmarks together, you will be able to understand that my minimum price is this and my maximum price is this, and most of my prices, the average is this. On the same for the mean and the standard deviation.
Are output cells that contain formulas that refer to one or more assumption cells. These are the accounts for which you want to see the effects of the uncertainty. In this case, I'll set it for sales. A forecast chart with a single point estimate is shown. With the forecast set, I can run the simulation. When the simulation runs, Random numbers are generated for each of the assumptions. This simulates how different scenarios of values can occur for these variables in the real world. For each scenario, the model is recalculated and the results are shown in the forecast chart. After running the simulation for a few hundred trials, the results start to converge. Below the forecast chart are key metrics. Here's the base case, the worst case, and the best case. This info box shows that there is only a 31% chance of reaching or exceeding my base case of 778 million. I'll add a stretch goal as a second target value. With this information, the company will have a much clearer picture of the chances of success for their expansion plans.
Well, this is what it measures the probability of your decision. For example, here, when you are targeting 800 million of sales, that means your probability to do that is 17%. Okay, here you can see that. And my probability is around 50% to do 750 sales. It's a way to minimize the risk here when you are taking the decision by understanding the right probability, how much the probability to achieve my assumptions. It's a second layer of assuring your forecasting and drivers on the right track rather than guessing the numbers of the drivers. Then you need to validate your guessing and your understanding by running such Monte Carlo analysis to
The updated chart
validate your decision.
shows the higher risk of meeting the stretch goal target. The stretch goal displays a 17% chance of reaching this goal. With information from simulations, you can better understand the uncertainty surrounding our strategic plans. In this tutorial, you saw how to run simulations to help improve forecast accuracy in strategic modeling. To learn more,
Well, now with these tools, you can go out of a crisis. You need to go for scenario planning. You need to use such tools. You need to look ahead to the new normal. Once you are now managing, you need to look at the new normal because everything has been changed. Corey Berry said that customer shopping behavior has changed forever, which means the historical information that we have now is not that much useful because we don't understand exactly what's going to happen in the next year. We need to build again a new historical information to be used again in our budgeting and forecasting. And that's why we need advanced tools to help us during this time. Actually, if you can hear about Best Buy, maybe you imagine that they are go from bankruptcy or something. Actually, no, they were trying to make use of the opportunity and achieving more revenue during this. If you can see in this slide, they were competing with Amazon. Okay, and here the Amazon is the brown one, and Best Buy here is the blue one. You can see that all of them were downgrading in March in October 2020. However, they started to move forward in December and in different. That's November, okay, and that's March. All right, so March here is the crisis, and here this is the November, and this is the earning per share for them. So they were trying to utilizing the opportunity. They are trying to do cost saving, maximizing the revenue generation. These people know how to use scenario planning and how to make use of the opportunity. Actually, we finished the webinar. I'm just here summarizing what we said, that with powerful tools that makes you agile to analyze the effect and fast changing business circumstances, only you will get the value of the opportunity, whether it's good opportunity or bad opportunity. You can manage with such tools to be able to measure the impact of your decision. we did not finish the speech about Enterprise Performance Management Cloud. We just speaking about the strategic modeling and how to create scenarios. But actually, it's one of the features. There are many features of the EPM Cloud, like how to do connected planning, as I said, and also how to do the visualization and dashboards for reporting and formatting your reports and putting your measures and KPIs, how to focus on profitability and cost management. I mean, how to do the right allocation of expenses on the different accounts to get the right profitability of each product, each department, each employee. You can reach to even to if you're going to make use of the management team, how much it's going to cost you. Then the narrative reporting, and this is how to close your reporting, how to make your reporting neat and clean, how to put the dashboards with comments and make this available for external people. Actually, the EPM Cloud is a very huge suite, and it is categorized in Gartner as the first over the world in financial planning and how to bring insights in the area of forecasting, budgeting, and planning. And thank you for your attendance here. I hope we try to add value for a topic. It looks complex and requires more information and a lot of information. We try to make it simple as possible. We are going to provide different webinars with EPM Cloud for the planning, for the profitability, for every aspect of the planning and budgeting processes. Thank you. And here the people are going to send you the different other invitations to the different webinar. Thank you. The mic to you, Sharif.
Thank you, Mr. Hatem, for that fruitful information. Thank you, everyone, for attending our webinar today. We are looking forward to seeing you in our next webinars. If you have any questions, feel free to contact us. Also, you'll be receiving an email contains all the info about our webinar. Thank you so much, and looking forward to seeing all of you.